this was created for the average, hardworking professional, someone that is there to build, to serve, to protect. And it's created for people who are tired of losing money to taxes, to the fees, to the interest paid to the banks.
The longer that you control your money, the more that you experience the dividends and the uninterrupted compounding, the stronger your banking system becomes. So do you really want to wait until tomorrow, or do you want to start today? On today's episode, we are going to do a little myth busting. And I just had a conversation literally yesterday with my sister who said, "Hey, Jeremy, I'm going through the Nelson Nash book, Becoming Your Own Banker. And this sounds great, but it's not for me. This is only for the wealthy." And I've heard that before. I know that you've heard that before. But this episode today is going to debunk that myth, all right? We want you to understand and walk away from this episode understanding that IBC isn't for the wealthy. Rather, it's for the willing. Most people think that they need a six-figure paycheck in order to start building wealth. But here's the truth. You don't need more money. You just need a better system. And in this episode, we're going to dismantle that belief that you need to be rich to get started. High-achieving professionals often disqualify themselves from starting systems like infinite banking because of that self-limiting belief of, "I don't make enough to start." That belief doesn't just delay action. It actually robs them of the most valuable asset they have, which is time. So Jason, let's get into it. Tell our audience, what are they going to learn today?
Jeremy, thank you. Awesome stuff, man. Like always, what our audience is going to learn today, they're going to learn why IBC is, in fact, for everyone. Now, not everyone's going to do it, Jeremy, but it is for everyone. How professionals making $75,000 to $120,000 are implementing IBC successfully. What starting small looks like. Sometimes we might call this stacking, and why it still builds massive long-term leverage. The myth of, "I'll wait until I earn too money," and how that creates financial stagnation, and how to reframe IBC as a system of clarity, not just a luxury only for the wealthy. The mindset from borrower to builder, regardless of income level. I think that last one, Jeremy, is the difference between people who start and people who don't start, is that real estate between their ears and that mindset.
Yeah, I couldn't agree with you more on that. We keep talking about the builder versus the borrower mindset, and that mindset of becoming a builder is truly the discipline and the structure that it takes to go from, small to large, or take where you're at today and go even further, right?
That's right. I mean, that it is the difference between to be someone that's going to practice the process of infinite banking, as we're going to show, like so many people just like you are doing this. And they're doing this because, frankly, they got sick and tired of things not working the way that they want them to work. And so when they started taking ownership, and we're going to talk about this a little later, we're going to talk about how taking extreme ownership, because Jeremy, this time you're going to get it right. I always ask you the same question. There is one guarantee in life. What is it?
So I know it's changed after talking to you over and over again, but I can't get it out of my mind that the two guarantees in life are taxes and death. So we're just going to go ahead and turn that all together to one big bundle of terribleness. How about that? Change, taxes, and death.
Well, change, I don't know if change is terrible. Change could be a great opportunity, right? Not to derail our conversation we're having today, but change an event, whether you're looking at a financial market, that's every roughly 6 to 7 years. There's been 14 big changes since the Great Depression. So it's constant change in our life, whether it's something breaking, something that's unexpected good coming to us. Change doesn't always have to be bad. Change is just constant. Health, wellness, new addition to a family, right? There's a bunch of changes that we will all experience. And so how do we help someone see why most people think IBC is just for the wealthy, for the folks that have the family office and are worth over 200 million, like the gentleman we were talking about prior to this? That's not who this is for. This is for everyone. Like the first time I read Nelson's book, Becoming Your Own Banker, I thought, wow, if this was true, every single American would do this. So, Jeremy, let's tell these folks, why IBC is not just for the wealthy.
Yeah, well, it's really who is talking about infinite banking, right? You see a lot of wealthy entrepreneurs, real estate investors, financial influencers, those folks with a large portfolio are typically the ones that are going out there and educating people about infinite banking. But what people don't realize is that Nelson Nash, he didn't come from a high income family, right? He's really the one who exposed infinite banking to the rest of us. And it's for the average person, the hardworking person, that professional out there who just got tired of losing their money to taxes and fees and the interest paid to banks. That myth, Jason, that persists. This is only for the wealthy because of the financial advice of go out and chase higher rates of return. What they should be looking at is structure. It's structure that helps you become a builder, not necessarily chasing higher rates of return, right? So if you don't have a big income, you're told to wait. But as a builder, we're not going to wait, right? We're going to design around our current reality and plan for the future. And I really liked what you said earlier. Change can be good. It's really that unexpected change, the unplanned, that can be uncomfortable for people. But when you're structuring for the future, that change, exactly what you said, that is positive. And that's what I like about that. So thank you for correcting me on that.
Hey, you're welcome. You're trying to make it a big group of terribleness. I was thinking, Jeremy, it's not all terrible. And the real builders that we talk about all the time, they're not wealthy. What they are is they're disciplined, they're process oriented, they're long-term thinking oriented. So then when you do have a change, if it's terrible for someone else, guess what? For he or she who has the liquidity, the opportunity, the tax-free ability to use their system because they planned and built over time, guess what? Are you in a better or worse position when you do that? How many of you listening would think you're in a better position in the future if you've built something over time that is owned privately by you, that gives you all of these benefits we're always talking about, and you can leverage it when change happens to someone else that can't afford a beautiful property? Or maybe there's a certain investment that the price comes down and it's an opportunity for you in that moment. Change can be a really good thing when you're prepared.
Yeah, absolutely. And we look at people that are out there planning for that eventual retirement. And I really want to kind of run through a scenario here about how you can plan and structure your wealth over time. And if you look at kind of a lot of high income professionals out there, most people earn around $7 million dollars of income over the course of their life. Okay.
Yes.
So if you were to
Wait, wait,
delay,
wait, 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 wait.
uh-huh,
Wait, sorry everyone. How much?
over $7 million. Dollars.
Wait, wait, one more time.
Most people earn, on average, a little over $7.5 million dollars over their lifetime. They go
That's a
into
lot. Come on, I'm making the money, money, money. That's a lot of money. 7 million. I mean, does that person make millions of dollars a year, Jeremy?
no, no. If they don't make it over the course of their life. So everyone that starts, even the people that do make it $7 million a year, that's getting into Parkinson's law, which we've had that discussion before, right? My expenses rise to meet my income, and
Yes.
even high net worth individuals can still be a borrower, not necessarily a builder, and that's kind of the distinction that we really want to get into here.
They are. And the reason I stopped and paused this on that $7 million is Jeremy, we're going to break this down a little later, but who we're talking about, who I am talking to, who Jeremy is talking to, is the people that want a process and are willing to learn something new. These can be anyone across all disciplines, right? These are our teachers, our contractors, our pilots. I mean, sometimes they're doctors, yes, but they're attorneys, they're your construction workers, there are investors, anybody who has discipline and is willing to learn and apply a process that is for them. It's for them. It's for them. These are the people that Jeremy and I talk to all the time. These are the folks that we're talking to that are starting. Jeremy, one of the best savers I ever talked to made $8,000 a month. And we talked about this on another episode. He saved 50%. That's 12% more than the wealthiest 1% has average savings since 1910. This guy. Why? Because he decided that paying himself and building that opportunity fund, and this is not even using whole life. He just had that discipline to start paying himself that much money every month. And I'm hammering this because it is a decision. How much do you value yourself? How much do you love yourself? And if you can't love yourself a little bit more, how much do you care about your family, your spouse, your kids, the people that are the most important in your life? Will you love yourself a little bit more to build something different and implement the process?
Yeah, you know, the reason I find that so impressive, Jason, of saving 50% of your income or his income, the average savings rate in America right now, you kind of alluded to it, it's less than 4%. So for every $100 you make, you typically keep a dollar or $3.50 in your pocket. That's a problem. So where's all that money go? Right? And we've talked about this before. It goes to what? Taxes, it goes to hidden fees, and it gets eaten up by inflation that's out there. Debt service is probably one of the big ones. We're talking about the cumulative volume of interest, right? When I talked before about how my mortgage was 2.25%, but because it's amortized over the lifetime of the loan, I was effectively paying the bank 38%. How does that math work out? Well, it's amortization. Go look at your mortgage statement. Tell me if the interest that you're paying on that is the true interest rate that you owe to the bank. You'll typically find that the interest on your mortgage is higher than the principal balance, and that's just the mortgage. What about your student loans, your boat payments? You start factoring in predatory fees, and I call it predatory, when the credit card companies are charging 23 up to 27%. That's insane. So that's where people's money goes. It goes to the taxes and fees and debt service. All of that erodes wealth over time.
And of that $7 million, I know you're going to get into this a little bit more mathematically later, but like what you're saying is that average people aren't understanding that this was created for them. This was created for the average hardworking professional, someone that is there to build, to serve, to protect. And it's created for people who are tired of losing money to taxes, to the fees, to the interest paid to the banks. And where do these myths come from, Jeremy? I want to kind of dive into that, like this traditional financial advice. Let's talk about that for a second. Let's talk about how people have been programmed to give up control of their money, to assume all the risk. You guys hear us say that, but I want you to start looking around the world. And by the world, I mean your mailboxes, your TV, your radio, the podcast you're listening to. Start noticing. Because when you start noticing and becoming aware, that's when you know, hey, you might be just preparing yourself for making a switch.
I will say that everything starts with language, Jason. You have advisors out there who speak in cryptic language about
Mm.
investing and the way that money moves and say and make you feel as though you shouldn't control your money. So what do you do? In order to get to where they're telling you could be, you have to give up control in order to be able to day trade or invest in real estate or do something else along those lines. But keeping control of your money is a lot more simple. If we're able to stop those leaks, stop the hemorrhaging of your income, stop, giving all that money out to the debt service, the creditors, the hidden fees to those financial advisors. Tony Robbins talks about a 1% fee over the lifetime of paying into a mutual fund can erode your purchasing power, your retirement income by a decade. That's 1%. What's the average that a financial advisor might end up charging? Not to mention, you start adding in the fees, the expense ratios of the actual mutual funds themselves.
If the language isn't clear, concise, and kind, if you hear someone speaking of money and investments in terms that you can't understand, it's not simple. If it's not simple, it means either the person that is selling you this dream doesn't understand what they're talking about, or they do understand and they want you to give up control. This is all financial marketing, and it's very much, Jeremy, because the first thing we're talking about is three words, right? Think long range or think long term. Don't think about things in terms of month to month or in, year to year even. Let's think about it decade to decade. Let's think about what your decision today will mean 5, 10, 15, 30 years from now. And we're going to go into this a little bit with a little formula that I picked up in a little self-help book this week, Jeremy. We're going to, get into that here a little down the road, but just the thought being, if we're thinking long term, if we start noticing that everyone's asking us to look for a big ROI versus understanding that we are going to care about our money more than anyone else ever will. So if it's complicated, it's not for us.
Yeah, let's run into a scenario real quick, right? If
Sure.
you're able to, let's say, save $6,000 a year in taxes, $6,000 a year in interest payments, and $6,000 a year in hidden fees, cumulatively, you have $18,000 back into your pocket.
Hmm.
But what are you told to do? Go chase higher rates of return. Let's say that you are a conservative person and you want to go chase that higher rate of return, but we're going to invest your money into an asset that earns 6%. Jason, to make $18,000 earning 6%, how much money do you have to invest? 300,000.
Oh, I was gonna
$300,000.
answer, man. I knew the answer. I actually did the homework. You gotta do $300,000 to make that. So which would you rather? Would you rather have money that didn't go to Uncle Sam, that didn't go to someone else's family? Because with Jeremy, to recap what Jeremy just said, you're paying 6 grand to Uncle Sam, our favorite uncle, 6 grand to someone else's bank, and 6 grand to someone that you may or may not even get to talk to more than once a year to manage these things. So do you want to keep giving them? It's them, or do you want us to have the money?
Yeah. By us, back to the you and me level, like, right?
Yes.
I think it's
Yes.
easier to keep $18,000 that I earned, that I did my sweat equity for, versus go out and chase higher rates of return. The net effect is the same. I got 18 grand, but which one is harder to do? Make 300 to then go out and invest and put it to risk, or to recapture what you're already earning? Now, if you have the ability to recapture and invest at the same time, now we're looking at
Mm.
multiples. This is where it can really take off. And that's what I love personally, how I use my banking strategy. I recapture those taxes, those interests, those hidden fees, and then take my policy and use it as an opportunity fund. So I'm then really compounding those effects. And I didn't need to start with a lot of money to do this. That's what's incredible, Jason. I just needed to start.
You just need to start, Jeremy. And what Jeremy is talking about, he's talking about first building wealth by just really understanding where your money's going, keeping it, which is what we're teaching you here today. And what Jeremy just told you, we always know success leaves clues. Tony Robbins said that. And Jeremy just said, listen, Jason, I brought these things back to me, taxes, interest, hidden fees back into my family. I put them someplace where I control them. And now I'm out multiplying the money. So build, keep, and multiply money.
Yeah, absolutely. That's a fantastic formula. Keep more of what you end up making, and then turn around and multiply it, and allow that interest to take effect over time. For some reason, it just popped in my head that whole. Would you rather me pay you, what is it, like $1 million, or a penny every day for 30 days, right?
A penny
Um,
that doubles every day for 30 days.
it's actually pretty powerful when you think about the compounding effects over time and the way that this really can take off. Infinite banking works kind of in a very similar manner, right? The longer that you're practicing, the longer that you control your money, the more that you experience the dividends and the uninterrupted compounding, the stronger your banking system becomes. So, do you really want to wait until tomorrow, or do you want to start today, right? Like, it's to me, I had that internal struggle. Like, this sounds too good to be true. This is for the wealthy. This isn't for me. And when I found out what I'm actually doing is structuring my wealth, that was a complete mindset shift. Like, that's like, oh, this can bridge the gap between saving and investing. And that's what we're talking about. We're bridging the gap between saving and investing.
And what you just spoke about was something that you didn't go into deeper, but you gave common objections. Oh, if this was true, everyone would do it. Why don't I know about this? It's only for the wealthy. Just regular objections, but those objections, which I just heard you speak about, are based in fear. Fear of failing, fear of rejection, and you might be rejecting yourself. Like you might have a story around it that you don't feel worthy. This is not for you, not because it's not accessible, not because you can't learn it, because you have an underlining money rule that you've been told over and over that you don't feel worthy. And I felt a little bit of that coming from you, Jeremy. Did it? I mean, we didn't talk about this prior, so I don't want to put you on the spot. There's not a spot, by the way, anybody who's watching, but was there a little bit of that and how you just shared that?
Yeah, yeah. Like, I've told the story before. I don't come from money, and I grew up kind of more in a preservation mindset. Like the idea of trying to put my money to work, I've always wanted to create that financial safety net before I did that. Because growing up, we didn't have income. I would say those financial discussions, or I really say turbulence, was probably one of the catalysts that led my parents to divorce. And
Mm.
so the talks around money were really like, we don't have it. We can't afford this. We can't do that. It was a lot of I can'ts, not how can we's. And so my mindset around money had to change and it had to start. And that's where we kind of came up with this concept between borrowers and builders.
Thanks for being vulnerable and sharing a little bit of that. And I have a very similar story where there was lots of no's around money or lots of, we don't need that, you know? And it also ultimately, I believe, led to my parents' divorce as well. Wasn't the only thing. Time was involved in there and other stuff, but money was always really like walking on eggshells. It was one of those things that we promised in episode 1 that we were always going to talk about the things that people don't want to talk about. Money, politics, religion. We want to normalize the things that are super important so we can have language around them. And Jeremy, to bring this back on track here, to bring us back to what we're getting to, a lot of people might hear this and they might not make any action, right? They might say, "Hey, I just don't feel ready yet. I'm just not prepared yet. When I make X, then I'll look at this." What would you tell those folks? What is the cost? Because there's always a trade-off, always a cost in saying those type of things.
Yeah, I hear a lot that I'll start once I have more money, right? Is that what you're getting at? Hey,
Yes.
I'll start this process when I get more money. And that kind of goes, one, we alluded to it earlier, Parkinson's law. Do you really start taking care of yourself when you have more money, or do you continue to give more money away? I think that without a system, though, and the ability to retain and grow what you earn, that moment of I'll start when I have more money, that never arrives, Jason. Like it just doesn't. And
No.
worse,
Well,
here's the other.
why? Pause right there. Why doesn't that ever arrive? There's a reason. There's a psychological reason, the languaging that you just used, why that will never arrive. If you say, "I will do this when this happens," you're literally giving yourself permission not to take action. You're giving yourself permission not to start changing a habit, a fundamental habit. The first law of wealth. Go read The Richest Man in Babylon. Pay yourself at least 10%, right? And so it doesn't matter if you're making 40 or 50 or $60,000. It doesn't matter what your age is. That one habit right there, you start making that automatic, automate it, make it simple, start paying
Yeah.
yourself, and all of a sudden, you're already showing yourself you can do it. You've given yourself permission. Because what
Oh,
you're
that
telling yourself, right, Jeremy, is I can't do this yet because I'm not smart enough, I don't earn enough, I'm not worthy enough. Whatever your rule is, that's what you're telling yourself.
and that's a really powerful tactic that you can implement as well, right? The automation, the forced automation of savings. That's what I used to do, or I still do it today. But when I was starting to like reframe my idea around money, I didn't start big, right? I didn't wait until I had money to go out and invest money. Every single 2 weeks when I was getting paid in the military, I had a direct deposit going into an account. And that account I would then take, and I was effectively cost dollar averaging in index funds at the time. And that allowed me to grow wealth over time. By cost dollar averaging, I was hitting the market, I was getting highs and the lows. And, if you do go into investing in Wall Street, I think index funds are a lot better solution for most people because you're basically betting on the US economy and doing it by cost dollar averaging. You're getting the average over time, which is great. Mine was automatic, Jason. And what's great about infinite banking is you could also do this automatically as well. Because, and my wife has to do it because it's out of sight, out of mind.
Hmm.
If she automatically does direct deposits, premium deposits into her infinite banking policy, then what? She can't spend it. So what's she doing? She's actually paying herself first, exactly what you were saying. Pay yourself first. Pay yourself with interest.
Yeah.
Richest man, go back. Those aren't our principles. We did not come up with that. We're just doing what the wealthy do.
And when you're not making a decision, you are, in fact, making a decision. So when you're delaying, Jeremy, there's a cost involved. There's a cost of delaying. There's a cost of not feeling ready. And the cost is that you're transferring the wealth to someone else. You're transferring the wealth to the banks, to Wall Street, to the advisors that are charging you a percentage. So that reclaiming that power, that decision is ultimately that permission and that ability to shift from the borrower to the builder.
Yeah. And here's the scary thing, because we do use a product to implement the process of internet banking, right? The product is properly engineered whole life insurance. Oh, big surprise, right? What does that entail? Underwriting. The underwriting. So the longer you wait, the more you risk your insurability. That's the problem, that's the additional problem that we don't typically talk about. But if you continue to wait and put this off, you're actually increasing the risk of no longer being insurable. And that can hurt your ability to become your own banker with regards to using the product that we love most, right? The one that predates the IRS tax code, the one that gives all the features and benefits that we routinely talk about, or that are on the website, wealthwisebanking.com. Go there. Start there if you don't know where to start.
100%. And Jeremy, you know how Jeremy, if you don't know this about Jeremy, Jeremy's pretty structured. Pretty structured. I said, Jeremy, 3 minutes before we started filming this, I'm like, hey, I want to introduce something that I read in this little tiny self-help book called Be Unstoppable. It was from Bob Resnick, Jeremy. And this is as good as time as any to introduce this. May I introduce this?
Absolutely. Let's do it. Rock and roll.
Okay. So simple formula. Now, if you're driving, I want you just to remember it. But if you're not driving, write this down. Got it? Write it down. E plus R equals O. That's the formula. And your E is your event. I asked Jeremy earlier, what is a one constant thing? A change. Well, change can also be an event, good or bad. It's just an event. R is our response. Equals O is the outcome. So, Jeremy, I'm going to give you a quick two scenarios, and then I'm going to ask you what you think about them.
All
So in
right.
scenario one, someone earns or gets or receives, maybe gifted, $1,000. And now they're so happy. $1,000. Oh, baby. I'm going to get some new threads, some new stuff. I'm going out. I'm going to get some shades. I'm going to look rich. And they go get that stuff. And that is their response. Receive money, go spend money. Your outcome, still broke. No more money than we started with, right? Now, the same event, another person receives the same amount of money, $1,000, $10,000, whatever it is. And their response is, hey, I'm going to pay myself. I'm going to put it somewhere where it's guaranteed to grow, where it's going to grow tax-free, and where it's going to protect my family. Pass on wealth. Their outcome is way different. Person A is still at that zero line. Person B has already started building something for the future, for long range. So that simple formula of E plus R equals O is a great way to kind of look at what kind of decisions you're making financially in your life right now.
Yeah, you really just hit on the topic of why so many people who win the lottery or athletes who make millions and millions of dollars go broke, right? It's that mindset shift, a borrower or builder. Like you could have a ton of money and live paycheck to paycheck because they're doing exactly what you just talked about. They were living in that scenario one. They
And if
made
you
a bunch and they spent a bunch.
Yes, and if you start with the outcome in mind, right? When they win those things or they get those things, they're in the moment, which is beautiful. We should all be present. It's the biggest gift we can give. But, I just disclaimed everything I said prior by saying, but you understand that if you thought of the outcome of, hey, I want to feel secure. And if this resonates with you, then you know what to do. I want to feel protected. I don't want to have fear around my money anymore. I want to have certainty and guarantees. If that is your outcome, then when you have an event, you know what your response needs to be to have the actual outcome, right? So just reverse
Mhm.
engineer the E plus O or E plus R equals O. If you start with O, then you know what to do when you have the event, which the event is you going out and earning money or having returns come back to you. You know what to do. You know what the proper response is because it is a process, a strategy. It is starting small. It is being consistent, persistent over time. This is how you are the builder that you think you want to be, that you desire to be.
Yeah, you don't start this once you made it. This is the system that helps you make it. That's what I love about it, right? Even small policies, they're not junior versions of bigger policies. All they are, they're their own fully functioning systems. They still grow, they still earn dividends, they're still structured, and they create opportunities so you can make bigger decisions, have bigger outcomes in the future, right? That's the most important thing is to get started. Because if you don't start, what are you going to do? Keep putting off your wealth, keep putting off your protection, your sovereignty, right? That's a fantastic word I love associated with this. The sovereignty that I have, my
Ooh, say it again. Say it again.
sovereignty.
Yes, powerful. For all the kings listening, it is a powerful move when you take back control. Like, look how much fun we're having with this. Why can we have this much fun? Because we have Jeremy.
Sovereignty.
Come
I'm
on,
not a
man.
monarch.
You reminded me of Lion King, right? When they say, "Ooh, say it again. Say it again."
I
Yes.
know you're going
Yes.
there. Read all the Disney movies.
Yeah, that's where we were going with that. So we're going that, this isn't a matter of, and everything we're talking about is also your mindset. Like action or inaction, they're both a decision, and you don't have to start big. You have to be bold. Often,
Mm.
if you listen to me, a lot, like I talk about training and testing and teaching, and what's the hardest belt to get in martial arts? The white belt. Everybody's like, black belt. No, that's not hard. You show up and you do the work and you do the repetitions, you will go as far as you want to go on your road to mastery. But getting on the mat is the hardest thing.
You take that not just in your finances, but like every aspect of your life, right? If you want to be healthy, you got to start somewhere. My wife and I were having this discussion the other day, literally about health. It takes years to become unhealthy. It also takes years to become, Mr. Olympia. But everyone started at the same point.
Hmm.
One chose a specific path that led to health, and the other one chose a specific path that led, down and to be unhealthy. And your finances are the same way. So, what steps are you going to take to have healthy finances?
That's beautiful. I appreciate that more than you could even imagine. Here's something I was sharing with Jeremy when he was sharing this with me was, I've quit a couple things in my life. I've kind of not been drinking coffee the last 3, 4 weeks, no breads or, just really eating super clean. And usually when we give up those things, it feels like a loss. This time, it feels like an addition. A subtraction can be an addition. When you know what your outcome is, a subtraction can be an addition. So when you're looking at things that might be equivalent to coffee or eating food late at night or eating things you're not supposed to eat, there's an element there of you feel incongruent to yourself, meaning you don't feel aligned with your soul, your spirit, your physicality. They're not in alignment. And that's why you feel bad about yourself. And that's why you have shame. And that's why you have worry. And so when you give yourself the permission to be what God intends you to be, everything can become simpler because now every decision that's bringing you closer towards where you believe you should be, healthy, wealthy, fun, loving, is all based in that decision based on your outcome and being in alignment with your true calling.
Yeah, no one's going to take care of you better than you take care of yourself. That's hands down with your health, your wealth, everything. Stop delegating, stop blaming others, take back control. It's up to you. If you want to be healthy, you want to be wealthy, it's up to you.
And those are the folks we work with. If you don't want to take ownership of your health, of your wealth, of those things, then you might not like this, but you're not for Jeremy and I.
Yeah.
Now, we love everyone. We will help everyone, but it requires you taking radical ownership and what, Jeremy? Taking action or sovereignty.
Sovereignty. All
So
right.
you don't need to be wealthy to use IBC. You need to be wise. And wisdom isn't about waiting, it's about taking action, Jeremy. So I think we're pretty much at a wrap of this episode. So, any final thoughts from you?
No, I just want to remind everyone out there that you're already in banking.
You're just not the banker yet.
Until next time.
Till next time, be blessed. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.